Good afternoon, everyone. You got Rod Crandall here, Chief Integration Officer of U.S. Advisors Insurance. Appreciate you being here today. This is our monthly installment of our Coach's Corner. This is something that we do on the third Thursday of every month at 1 o'clock Central. We have a wonderful guest with us today, Mr. Brad Mills from Symetra, one of my favorite wholesalers, one of my favorite companies. If you've tuned into these Coaches Corners in the past, you know that we have a focus on identification, positioning, and introduction or implementation, right? And so often we don't highlight product companies, but we're going to do that here today, and you're going to see a little bit more of that. We picked Symetra because they're one of our favorites, and I won't steal a lot of the thunder that Brad might have, but they have some really great products and great strategies that we want to pay attention to. Today, we're sort of titled this Proven Concepts in both Wealth Transfer and Supplemental Tax-Free Retirement. And so in the next 45 or 50 minutes, we're going to hear a little bit from me and a little bit from Brad, and we're going to walk through some items. And here's really what our agenda really looks like. We want to talk about what's going on with taxes. There's a lot of different things going on with taxes and a lot of different types of taxes. Generically speaking, as taxes go up, the viability and appropriateness of insurance goes up, right? We can trade the cost of insurance for cost of taxes. A lot of this is about asking the question, is this about death benefit or cash value? People think about life insurance. The number one thing I think about is what kind of design are we talking about? Something that has a maximum death benefit and a minimum cash value, or do we want something opposite? So it depends how we want to utilize the asset class of insurance. And Symetra has really great solutions in both places, which leads us into number three. Well, where does Symetra shine? And we're going to hear from Brad and see a couple of case studies on how those designs can work and who they might make sense for. And then we're going to wrap up with, okay, if we know what's going on and we have these great opportunities, how do we effectively engage our clients better and have more appropriate conversations with them around these strategies? Right? What I can promise you is a poor strategy would be to go to your client and ask them if they want to give you $50,000 a year for their insurance premium, for example. Right? And yet, Brad, and even my practice, we have a number of people who give $50,000 a year, or maybe even more. Why would they do that? Right? So you're going to hear a little bit in this conversation today about what insurance does, not necessarily what it is. And to the extent that taxes go up and our clients create and distribute more wealth, the cost of taxes ends up getting pretty onerous. And utilizing a specially designed asset class called life insurance can make a whole lot of sense. And so that's what we're going to be describing here today. So let's talk about taxes, right? So what is going on with taxes? You got a number of things to really pay attention to. We do have record debt levels, and I'm sure all of you are aware of that. And I'm going to show you a tool in a minute that might blow your mind. That's going to show you a live clock of what that debt level might be in the various ways, right? I believe because of that, we're very likely in an increased income tax environment, right? In fact, if you look historically, we're in a pretty low interest rate environment relative, make that a low income tax environment relative to where we have been. We have had highest marginal tax brackets north of 90% in this country in the past. And so when you really consider that and you look at the debt that we have, I think something's going to have to give. And I believe our best clients are going to be giving the most, and we need to be paying attention to that. The third bullet point there is the 10-year rule that came out of the Secure Act. I'm sure most of you are aware of this, right? It's a 10-year rule for non-spousal inherited IRAs. What that really means is that as a beneficiary of an IRA, I would have to take all of that money within the first 10 years. So I'd be a perfect example of a beneficiary where that would be the least effective asset to leave me, right? Because why? I've got to take that money where? At my highest marginal tax bracket, and I've got to take it. I'm 45 today. I've got to take it by the time I'm 55, and I don't want to take it. I want that to be retirement income, right? So I'm not going to be upset with inheriting an IRA, but mathematically, it's pretty inefficient. By the way, what if mom or dad is in a low tax environment and maybe you have a physician or a very successful person in the highest tax bracket? So these are things that can be identifiers for people that ought to have a conversation to determine whether they should have some insurance in force for liquidity purposes. We have an estate tax rollback in 2026. Current law will roll back the estate tax exemption to around $5,000 or $6,000, make that $5 or $6 million in 2026. It's about $11 million today per person. And so that's automatically going to roll back under current law, and that's going to expose a number of our clients to estate taxes that they wouldn't otherwise be exposed to or aren't exposed to today. I remember when I came in this business in September of 2000, the estate tax exemption was $675,000. So that would have been almost 25 years ago. It was 675,000. Now it's like 11 million, and it's being cut in half in 2026. That creates opportunities for conversations. Outside of the estate tax, you have state estate taxes. I know many on the call are in Minnesota. Minnesota has an estate tax for any dollar over 3 million, right? And so what these taxes do is they create potential liquidity issues for us depending upon where the wealth is, right? And so it's my premise that because I think these taxes are going up, we have to pay more attention to insurance solutions than we ever have, because insurance solutions can eliminate all of these taxes if properly funded, properly structured, and properly owned. So let's take a peek at the US debt clock. I don't know if any of you have ever seen this. I'm going to have to switch screens real quick to this. All right. So this is usdebtclock.org. So if you can take a look at this, and hopefully you're not too sensitive to movements and lights, but I look at this and it blows my mind. I could spend a half hour here with you. I want to highlight just a couple of things. So this is a real life clock indicating US national debt at 31 trillion today. Find it interesting that that comes out to 94,000 per citizen, but look at that, $246,000 per taxpayer. That's crazy, right? They have this debt clock time machine. So remember this number, 31 trillion. Let's go back in time. Okay, what is it? It's 2023. So let's go to 2012, right? So that's 11 years ago. And now this will go back in time. The debt was 14.9 trillion. That is crazy, right? And look at what it's projected to be. Let's go out to 2027, so 4 more years from today. When we go out, what are we projected to be? $44 trillion. Now again, where are we going to get these dollars from? And it's my belief that it's going to really come from our most successful clients effectively, right? Those who have the money are going to pay more. And it's going to be even worse for those that are in states that have high state taxes as well, like California and other. And so this debt can be very burdensome, and it just continues to increase and increase. Now notice you can drill down by state debt clocks, right? So let's take a quick look at Minnesota, for example. So this is a great tool. If you haven't looked at it, I suggest you look at it for yourself. You might even want to share this with some of your clients. I've had some amazing conversations by just sharing this with clients. Minnesota's got 5.7 million people, and here's our debt and continuing to go up. And so it's pretty cool. You can look at it world clocks, state clocks, and the United States clock. Let's just take a real quick look at the world debt clock, just because we don't have time to go through it, but I'm so interested in it. But take a look at this. The national debt, US national debt, is higher than any. Look at these, right? Okay. So I just feel like this is a good data point to understand, should we utilize insurance in our portfolio? People are thinking about what insurance costs them. My best clients, our best clients, are buying insurance not because they specifically need it, but because they want it, right? And they want it because we get extreme tax favored treatment of life insurance. And thus the cost of insurance can often be less than the cost of taxes. All right, so let me flop back to my my PowerPoint real quick. And then that brings us into how I'm going to introduce Brad in a minute, right? Is that if we're going to do this right, we need to understand, what are we trying to solve for? Are we trying to solve for death benefit or for cash value? And generically speaking, the best way to buy death benefit is term insurance. You want to buy the least amount of premium for the largest death benefit. The problem with term insurance is it's designed to terminate before we do. Right? So we utilize maybe a guaranteed universal life structure, some permanent structure, right? We want to put the least in for the most. That's the generic strategy if we want to maximize death benefit. If we want to maximize cash value, we have to do the exact opposite. What we want to do is we want to put the least amount of coverage in place with a maximum contribution, and we want to follow the IRS laws generically the Section 7702 laws describe exactly what we can do without violating those rules and thus creating a modified endowment contract, which will not allow us to take dollars out on a tax-free basis. Many of you may or may not be aware that the majority of Fortune 500 companies utilize specially designed policies for accumulation or cash value focus for their best clients. And many of those people are funding those with Symetra products as well. Right, at the end of the day, the idea about the cost of taxes versus the cost of insurance, if we structure an accumulation policy appropriately, we might have a 1% cost drag or less on an annual basis. And so what that means is maybe we have an index product that we're earning a 6% return, for example, but maybe we only get a 5% tax-free return. And that's because we got a 6% return, but all of our costs inside of the contract drug that down to 5% tax-free. It costs us 1%, but it's income tax-free. So in what equivalent tax bracket would an individual be in? Some of our best clients are going to be in a 40 plus, especially when you account for state taxes as well. And so even in a 28% bracket, you need to get make that 6.94% to pay taxes at 28% to yield a 5% tax-free return. And so if you followed me, I'm indicating that in some of the structures that Brad has and other carriers, we can actually have the cost drag of the insurance be less than this 1.94% drag here. And that's what's really interesting. And when people really understand that, you get questions like, wait a minute, how can they do that? And the answer is you got to qualify for this. You can't just send 50 grand to Symetra. They want to qualify you through an underwriting process. All right. So with that, hopefully I teed that up generically. I want to introduce Brad. I'm going to stop sharing my screen so that he can pull up his. And he's going to go in and talk a little bit about how he views cash value versus death benefit plays, a little bit about Symetra and their portfolio, share a couple of ideas and designs for you. So with that, Brad, the floor is yours, my friend.
Hey, thanks, Rod. I appreciate it. And it's good to see some familiar faces or names on dialing in. I know we've done this a couple of times, and I love doing business with U.S. Advisors. They're one of our best distribution partners, and going out to the agents and writing financial advisors that could do this is a great benefit to all of us. So I appreciate that. Appreciate your business. And with that said, I'll just get right into it. I mean, basically, as Rod's saying, teeing up some of these strategies, I have on the screen here wealth transfer and supplemental income plan. But the first one I want to dive into is just a quick case study on leveraging alternative assets using life insurance. We have a male, age 67, has a current policy, so just kind of a policy review here. No longer concerned with the state taxes because, as Rod mentioned, that exemptions went way up, so they're not in this 11 or 11.5 million. Could change in the future, but basically he's not too worried about it at the moment. As we click on through here, Reagan, I have Reagan, my internal partner, driving the bus, so I appreciate that, Reagan. I know a lot of you folks have very strong client relationships. So once you can have this tax conversation, product's really ancillary. So it's all about the strategy and what makes sense. So here's the client strategy. What do they want to do? Do they want to surrender the policy, do something else with the money? Could they make alternate investments to beat this? And what's really the purpose behind the insurance? So here's the setup. Currently, we're looking at seeing up a 1035 exchange, so a tax-free transfer into a new Symetra Protector IUL policy. The death benefit version here is important to them. So this is a death benefit leveraging wealth transfer to the next generation and funding that with their current premium is $30,000 a year. We're going to see what this internal rate of return looks like and tax equivalent yield, as Rod was stating, and see if it is a better deal to do this sort of leverage or to do something out on the outside world with it to see if they could beat it. So that's really IRR in a nutshell, is what rate of return would your client have to make in an alternate investment to beat this strategy? The IRR story on steroids, is what I call it.
Yep, yeah.
So at life expectancy here, I know there's a lot of numbers on the screen, but this is very similar to Rod's numbers. We're taking only a 24% federal income tax rate, not applying state, not applying a high income earner at 40%, just a 24% federal income tax rate at life expectancy, male age 86, they would have had to make 6.4% in an alternate investment to beat this. So that's that. It's just pure math, $855,000 of death benefit, and that rate of return growing with their 1035 and their premium for 10 years, what that would have had to make to beat it. So there's a couple ways of looking at this. If you look at an alternate investment strategy, I mean, the stock market's been bounced around. I know interest rates are a little higher, but is there like a crossover point, I guess, is another way to look at this slide. So if they only made 4% in their alternate investment, this is how many years past life expectancy would it take to grow the alternate investment to grow to match this. So they'd have to wait 10 more years. They'd have to live all the way to 91 if they got 5% every single year compounded annually. And that's, we know there's no guarantee in that. And at 6%, they would have to live to 89. So I think it's a pretty safe bet. You have years from, our client 67 all the way to 89, where you're locked in at this $855,000 death benefit and the rate of return back to his or her heirs. This is just kind of the backdrop, like I mentioned. I guess one thing I point out, target premium is pretty nice on this case, $24,000, but that's not the reason we do this. We do this because the strategy makes sense. And it mentions our index strategies. We don't have time to get all in depth to each product specific. We're kind of at a high level here, but we have 6 uncapped strategies for attainable results. We really try to build a product. We call it value transparency, sustainability, to where we have a low charge structure and a good benefit for the client and the advisor. Which speaks to our competitiveness. I know Rod and U.S. Advisors have the gamut of insurance companies. We can't win every single case. We wouldn't be competitive at others. So we have a very strong mix of protection sales as well as accumulation sales. We'll get into that next. But I just wanted to show real quick at a high level what we're looking at versus the competition. So when you're looking at a protector or death benefit type sale, there's a few different columns that I believe are important that kind of check the boxes, so to speak. Low premium, high targets on compensation, and low charges. That's what we've built this on. And our Protector IUL has a guaranteed death benefit feature built in. And this example is a male age 50. We have a 34-year guarantee. Beyond that guarantee period, we're living on cash value in our index strategies and cost of insurance. So I think it's very important to point out some of the competition has much higher charges. So that just goes to the sustainability down the road of what's the actuality of hitting the numbers on the illustration or being there for the lifetime of the client when the client needs it, when we provide the death benefit on a permanent basis. Real quick, we have the ability to add chronic illness plus rider that can draw down the death benefit at 2% per month. We have a built-in chronic illness rider for a living benefit that's automatic on standard or better that gives the client access to half the death benefit or up to $500,000 lump sum or monthly installment. So just know that we have the ability to add these chronic illness living benefit type riders that gives the client access if they don't meet 2 of the 6 activities of daily living. All right, now on to the next one, supplemental income plan. So this is what Rod was speaking of. Do you want to maximize the cash value? Do you want to maximize death benefit and rate of return to the heirs? This is maximizing the cash value and rate of return to the insured or owner of the policy themselves. It's like, hey, I want something out of this other than death benefit to my heirs. So we have a quick sample here. We have a silver age fox at male age 45. Riding on the boat, but anyway, it's not a tree. Usually life insurance propaganda has a big tree and you fulfill the tree, but this is a silver age fox on a boat. Sales executive, age 45, has 3 children. He's in the 32% tax bracket. Your normal type investor client, a little more high-end client. Next slide, please. Has some current concerns, life insurance protection for the family. They think they'll have pretty adequate savings, but they want more. They can't access the Roth because the sales exec or the executive makes a little too much money. They're also concerned with market volatility. Sound familiar? So a lot of this stuff we see every day. All right. So this is just a typical client that you can plug in this plan if you like the strategy. So we call it a supplemental income plan, and some of the positives here of why to do this type of planning inside a life insurance wrapper, because Rod said, the COIs, deductions, admin charges, everything else, maybe they're 1% to 1.5%. That is better or less of a drag than what you're talking about if you do it in an alternate investment and paying taxes on it. So there's potential for income tax-free supplemental retirement income if you do it correctly with loans and withdrawals. And there's also a income tax-free death benefit during his working years that would provide for his family. So you have flexibility here. There's no IRS regulations. You can put almost as much as you want depending on your insurability factor of how much insurance you could qualify for. And with our index options, we have a 0% floor for downside protection. And as I mentioned, 6 uncapped strategies for attainable growth. This is just a quick snapshot of what a ledger would look like, but really this is a self-completing plan. If he dies early, we have this $600,000 death benefit growing. So what we did here in the case design is have the minimum non-max death benefit under that 7702 rule that Rod mentioned. So the minimum you can get by law for death benefit, and the maximum cash value growth. But it still has a nice death benefit, as you can see, grows. So here's where basically the rubber meets the road and a hypothetical income for a retirement supplement. We're basically looking at a 6% rate of return in the far left column inside the index product would yield $73,000 a year of income from age 65 to 84. So 20 years of distribution. So paying 20 or 19 and taking out 20. So that's the pre-tax equivalent he would have had to pull out of an IRA or 401k to match this $50,000 coming out of life insurance. So let me say, that's pretty powerful. Let me say that again. All right. So he could pull out 50,000 of this life insurance product if they made 6% a year on a hypothetical. He would have to pull out 74,000 in an IRA to equal this leverage. And as
Hey,
you can
Brad.
see, even if he makes, yeah, go ahead, Russ.
Sorry, buddy. I love what you're saying there. I didn't mean to talk over you. What if that's
No,
happening in a
I like it.
down market at the time that that distribution is occurring, like last year? That's another real benefit, especially having a
Sure.
zero floor. And we've just seen that just here.
There's so many studies on that, like sequence of returns and when you retire in a down market. That's the part of the flexibility of this as well. If you
Mhm.
have other assets and you're in a lower income tax bracket, take it out of the qualified plan. If you're in a higher tax bracket, you could take 50,000 this year, 40,000 the next, 20,000, whatever bumps you up to whatever tax level it is when you retire. You can play that tax bucket too. So good point, Rob, for sure. Next slide, please. There is a summary here, and we pretty much just went through that. But basically, the money going in and money coming out, and those tax equivalent numbers, what they would have to make. So pre-tax, I'll just key on the middle portion here. The pre-tax equivalent on this income here was 73,000, cumulative 1.4 million or almost 1.5 million worth of tax equivalent withdrawals in a 20-year period. And they put in, what did they put in this thing for 20 years? It doesn't say.
But it was 18
A
grand a
lot
year,
less,
right?
right, Ron?
Yeah.
18
So,
grand a year plus about 100,000, 1035. So
yeah.
a really strong rate of return on the investment slash insurance strategy. Just some additional riders and features. This is more product stuff, not the strategy stuff, but just so U.S. Advisors does the vetting on these products, and we have one of the best products with low charges, overloan protection. So if you strip money out, you don't have to have a phantom income tax on the gain. We have those living benefit riders for chronic illness, terminal illness, and you could add that chronic illness plus rider as well. We have surrender value enhancement riders feature if someone's really worried about the upfront loads or upfront cash value versus accumulation value, etc. Next page, please. And as I mentioned before on a protection sale, I wanted to show our competitiveness on this accumulation type sale. So really, this is all about the same thing. When we build a product, It's not rocket science. We want to have low charges, high targets, and a good value for the customer and the advisor. That's what we try to do in all of our product builds. So this is a very similar setup to the pay for 20 years person, except this is a short pay, pay for 5 years of a bigger lump sum of, I think, $100,000 a year for 5 years. So they kind of want to see the end of the rainbow and say, hey, I can't commit to a 20-year payment. I've got an extra cash now. I want to just get it over with in 5 years and be done with it. Same setup, minimum non-MEC death benefit, maximum cash value accumulation, and income solve. We're top of the heap as far as income solves, and we're low on the heap, so the best part on charges. So low charge structure, high cash value, good income solves versus all the normal competitors. So obviously, as Rod said, this takes underwriting, right? So they got to qualify for this. So I think one of the big differentiators in Symetra is, for one, the willingness of our Midwest team to work with U.S. advisors and roll up our sleeves, old school, win cases in underwriting, win cases in case design. But when we can't do that every time, we do have some built-in Symetra underwriting programs that can help your client place this case. I always say, we're not doing this for practice. Let's get these cases in and out the door and do what's right for you and the client. So we have some accelerated underwriting programs, and I go through real quick. I know we're getting a little short on time here, but we have some programs to where you don't have to go through the old school paramed, blood, urine, inspection report, phone interview. If you are standard or better, we have accelerated underwriting up to $3 million death benefit up to age 50, and 51 to 60, $2 million. So that's fluidless. So we need a full application. If they would be standard or better, we could give them preferred or preferred best if there's not much in their medical information history. And that we do all the background checking behind the scenes, no tele-interview. You get a policy in 3 to 5 days or an offer in 3 to 5 days, and you're off to the races on our accelerated underwriting program. Now, if all else fails and there's a couple nicks or a couple things we find, they would still have to do the paramed blood urine, but we're having pretty good success with that up to $3 million death benefit. And a $3 million permanent case is a pretty darn good case. We have Swift Term. I know I've mentioned that in some of our previous calls, our all instant, all digital term platform. And right now, Rod, even our numbers on Swift Term, we went up, it was 70 or 75% fluidless last year for 2022. This year already, we've enhanced our build chart and we've reduced our pricing, and we're at 87% for the first month and a half.
Wow.
No underwriting, going through Swift Term. And we have Good Life Rewards. We have Good Life Rewards program on our permanent products. So if you have a client with a couple nicks in them, it's kind of like a table shave program. It's a table crediting program wherever they fall. So we can credit up to 3 tables for good health history, doing their preventative measures, things of that nature on permanent. So we can underwrite a case and get Rod and the U.S. Advisors team involved. And kind of as a to leave on, if you guys have a pen, or maybe Rod, we can send this out as a link if you're due your follow-up. But I think a really great place to start to learn more about Symetra is our Advanced Sales Solution page, our Advanced Market microsite. It's www.symetra.com/advanced markets. We have all these strategies that have worked really well in the past, packaged up with nice client-approved material, producer use material with nice charts and graphs that explain these situations. And if you get in depth on case design, Rod and his team have access to, Reagan, my internal partner, and Matt, my associate RVP, and we can even run some of these case design samples specifically to your client situation that shows this pre-tax equivalent on these different plans to your client specific situation. So I just take a peek at this supplemental income plan I mentioned, life insurance as an asset class we went over, the IRR story on steroids, premium financing, annuity max. Some of those have really taken off. So with that said, I appreciate your time, and I'll throw it back to Rod for some closing comments, and really appreciate it.
Beautiful. Brad, really thank you so much. And thank you for your partnership. As you see, Brad knows his stuff. Symetra has great products. They're a great company. I think some of the things that I want to just kind of rehash or highlight, I suppose, is that, they do have very low charges in their IULs. That is not insignificant. And by the way, that's generally not promoted. Like people are ignoring that piece. Right? We get a sideways market for a period of time. I don't know if you remember seeing that slide, but you had some that were almost double the cost, right? And so you get in a sideways market, that cost can really eat away, and it is very low cost on that basis. Their accelerated program, they're leaders in that space. That SWIFT term, I mean, I've literally witnessed and seen and been a part of products that have been underwritten, approved, and placed in force in like one business day. That literally is possible and it's happening. He blew my mind with the 87% fluid list so far this year. That's really something. And so they're leaders in that space. And then, what also they're leaders in is really Brad. A lot of times when we get cases going sideways for any number of reasons, we rely dramatically on our regional vice presidents, the wholesalers that support us. And Brad is available at all times, and he understands that he wants to support us and we want to support him. So we get really great support from them. And I wanted to highlight a couple of those things. Brad, any last words for you? I'm going to kind of tie this up together then.
Yeah, no, I appreciate that, Rod. And as always, you guys are one of our best partners. And like I said, we don't do this for practice. We want to do the right thing for you, right thing for the advisor and the client. And I think if you do the strategies the right way, it all makes sense when it lines up in these sort of tax strategies, and you have that conversation at the strategy level. The product is secondary, and that's where we come in to try to fit the best product, the best underwriting for your particular situation. So
Yep.
I appreciate it, and we'll pound like heck to win your cases. I promise.
It's beautiful. I appreciate that. So if you like what we've
Yes,
been
sir.
talking about and you like Symetra, at the end of the day, if you're going to be successful in this area, you're going to have a plan, you're going to have to be intentional and to be able to make this happen. And in my experience doing joint work with wealth advisors for something like 16 or 17 years, the number one thing we need to pay attention to is client identification. Who do we need to talk to, right? And if we know who we need to talk to, how are we going to talk to them? Where are we even going to get into the entry point of that conversation? It's quite awkward if you pick up the phone and ask, hey, you want to put 50 grand in an insurance policy. So how are we going to have that point of contact? Oftentimes the client review is the best time for that. If you're like most of my advisors, that client review is like 50 minutes of how was your vacation and what's going on with the family. Here's the money guide reports or the Money Star reports, and then we're off and running. Well, what if we just took a couple of minutes and say, hey, do you want to talk a little bit more about how we could utilize some specially designed structures that might help you minimize the taxation for yourself and for your children, right? And so we have to figure out who to talk to and how to talk to them, and ultimately get that into a conversation where we can determine what sort of risk do they have and how do they feel about those things and what's important to you. And if we can do that, then we can help demonstrate how insurance can be part of the solution, not the entire solution. So I personally love working with wealth advisors that have comprehensive plans put together, and we can just stress test the plan, right? I love it when the plan is all in green and the client has 2, 3, 5, $12 million left over at the end. Well, how do you feel about that, right? And have you ever given any thought to how that money will be taxed for future generations? And is that something that concerns you, right? Do I have your permission to educate you on a strategy or two that you might want to be paying attention to? What if that strategy involves an insurance contract? Are you still willing to listen? Right? Because what we find is that most people, including myself, don't like what insurance is. I've got to talk to an agent, I've got to jump through hoops, but what does it do? And what this does is creates an asset class with attributes that no other assets have. And so what happens is people aren't even considering these structures, in my opinion. And the best way to have them considered is through the wealth advisor who's doing comprehensive financial planning, in my opinion. Okay. So if we break that down a little bit, we have to determine, well, who are we going to talk to? So if we're going to talk to somebody about an accumulation strategy or a supplemental income strategy, who are we going to talk to 55 that have either maxed out their qualified plan contributions, which is why the Fortune 500 companies utilize this. So often the top executive class at Fortune 500s end up being top heavy and they can't get maximum contributions into their 401k often. And so when that happens, we can do a supplemental deferred compensation structure effectively funded with contracts just like you saw from Brad. So we're looking for people, why 25 to 55? It's less about age, more about time horizon. Generally speaking, these accumulation structures start looking good 15 years and beyond. And the longer that you can have it go, the better. These are upfront weighted in fees and commissions, which is why people often go, well, we don't want to do that. Well, part of that, again, if not all of it, is the qualification. Right? If you want to write a $100,000 check to American funds, you can write the check and they'll take it. You write a $100,000 check to Symetra, it's getting returned to you because we have to qualify through that underwriting process, including now it's getting less and less cumbersome with these automated processes. But especially for large cases, you're often going to need to go get medical records. We often need fluids, a paramedical exam. They have to pay the underwriter, right? So it's more expensive up front to qualify than just sending money to American funds. So less about age here and more about time horizon. And then are they interested in reducing taxable income in retirement? Find me someone who isn't. I like to talk with taxes and start with taxes and ask how clients feel about taxes and where they think taxes are headed. Then I'd like to ask them if they've ever taken a look at what taxes have been historically. Then I'd like to show them that debt clock. Again, making a case effectively to bring awareness to the fact that people often forget that taxes are a cost. No one ever forgets the cost of insurance. Oh, insurance costs too much. But you don't often hear people say, well, the taxes cost too much. And our best clients are getting hammered. And I think it's going to be worse. So if you have a client like this is something that you could perhaps reach out to me or reach out to Brad or to Andrew on our team or George. Okay, most people on this call might work with Andrew or George. Reach out to them if you have a client like this, and they'll help you through that so that you can have a better conversation and you might be able to effectively benefit them in a mammoth way. And then we get benefits, right? We get to help people and we get to make money. Our job is to steward our clients to operate in their own best interest. And relative to insurance, a lot of times they don't do that because they might view insurance as a dirty word. And that's why we need to focus on what insurance can do for you, not necessarily what it is. And so if we talk about who should we have a conversation with about death benefit protection, well, there's a couple different things, right? You might find people that don't need their qualified plan for their own needs. So like they have this qualified plan, but they're not going to need it. Well, if they're not going to need it, what does that mean? It means it's going to go to somebody else. If it goes to somebody else, what if it goes to the kids? Now they have that 10-year rule. So if they have that 10-year rule, we might want to consider whether a death benefit focused strategy might make sense. And in fact, we might actually systematically withdraw money, especially if mom or dad's in a lower tax bracket than the child. Now we talk about child, but that child might be 70. Mom and dad might be 90 or might be 80 and 60, right? But again, this would be non-traditional uses for life insurance. Most people don't think that somebody who has a $2 million IRA that they don't need should have a conversation about insurance. Well, they should, not because they need insurance, but because they might want insurance because of that asset class that can create liquidity and might even outperform their current portfolio, right? To the extent people understand this, what ends up happening is the question shifts from should I or should I not do this to how much of this should I do? And then it's an asset allocation decision. That's so much of what it is. And people aren't thinking of it as an asset, they're thinking of it as a cost. But if we think of it as an asset, then it's like, should we have this asset at all? And then if we should have it, to what extent should we have it, right? So that'd be a good identifier. Those that own closely held businesses, children inside and outside. This is called estate equalization. A lot of times you might have somebody who's concentrated in a business and that's where their wealth is, and they want to treat their kids fairly and equitably. And a lot of times it's hard to do that because the asset might be illiquid. And so death benefit protection can create some equalization and again, include liquidity. When I talk about liquidity, what am I talking about? I'm talking about cash, straight up cash within a week of death, if not earlier, right? How valuable is it for an estate to be injected with cash within a week. And I would say, depending on the distribution of that estate, probably very, very important. And life insurance can be the solution to the problem, right? What about those taking RMDs that are unneeded? Same scenario as number one. Sometimes people just want to create a lasting legacy for their children. One of my favorite questions is, what's important to you about your legacy, if anything? And then be quiet, see what they tell you. You start asking that question, you might be surprised. They go, yeah, you know what? It's something that actually keeps me up at night. Then we can ask them to define that. And then we can ask them if they had a financial plan put in place and ask them how they feel about that. I was talking to clients this morning, their financial plan said that they had about $100,000 of income from their assets. They ran it out to age 95 and they still had $1.5 million left. What I said to them is, hey, congratulations. It looks like your plan's in good place. Is that how you feel? And here's what the lady said to me. She says, well, I believe in these guys, these advisors, pointing to the other guys on the Zoom call with me. I believe in these guys and I believe these numbers, but I don't really get them. And I'm really scared to stop working. Right? So there's this idea that you got to touch the heart before you touch the mind. So you start asking people how they feel about things, you might open up a whole new world than if you're just focused on math. If you're the average wealth advisor, it's possible you might be focused on math almost exclusively. And that's very important as a wealth advisor. But you've got to touch the heart before you touch the mind sometimes, and especially relative to these types of strategies. Okay. Those that are concerned about future taxes or transfer taxes, right? That's what we've kind of been talking about at the beginning, and that's kind of my core premise is the cost of taxes is likely going to exceed the cost of insurance for many of our clients. Okay? The number one thing I thought about with the 1035 exchange example that Brad bought was the last one. You know how many old whole life contracts are sitting out there with $30, $50, $70, $80,000 of cash value that the clients bought from their college friend at Northwestern Mutual or some other company. They have no idea why they still have it. It's not in their income plan. It's just kind of a lazy asset. And what if we could take that lazy asset and repurpose it? You want to talk about low-hanging fruit? The easiest way to get somebody to purchase new insurance after they understand it's important for them is to show them how they can do that with limited or no additional new dollars. They could just refinance or reposition what they've already got in place. By the way, if they've already got it in place, what does that tell us? They must see at least some value in having life insurance. And by the way, you could ask them, hey, is that the old kind of insurance or the new kind of insurance? Now that could be a whole webinar in and of itself. Generically, whole life insurance that was placed 30 years ago is the old insurance. What you just heard, Brad, that's the new insurance, right? Different riders, unique attributes, including different ways to take your income. You can have participating loans. So again, it's really a portfolio item. Let's give you a portfolio review of your insurance, right? So we use very similar language to the asset allocation conversation, right? All in context to the financial plan. All right, we alluded to some of these, but some of my favorite questions, again, what's important to you about your legacy? That's great because sometimes they'll tell you really nothing. I want to spend my last dollar. Right? Well, we want to know what we're dealing with, what's important. Well, actually, I give 10 grand to my church every single year, and I'd like that to continue if I died. Oh, well, that's an interesting conversation. So a lot of it's asking the right questions. Have you ever considered how taxes might affect your goal? You said it was important on a legacy basis. Have you ever considered the erosion of taxation? Is that something that concerns you? Right? With every insurance structure, in my opinion, generically, we need to determine what kind of risk do we have? And then we need to ask, do I care about this risk? And if I care about this risk, do I want to keep the risk? Because I can transfer that risk, especially if we're talking about long-term care planning, which I know we're not, but especially there. Okay. So we bring it to attention. We ask how they feel about it. What do they care about? Ask if they have permission to educate them on this topic, this strategy. And once they're educated, then they can really consider whether that asset class ought to exist in the portfolio or not. Would you like to learn more about that strategy? Okay. Brad, would you add anything to that? How'd I do on that? Curious what you think.
No, I mean it all sounds great, and like we've been talking the whole time, it's a tax bracket play. It's the cost of insurance versus taxes. It's a it's a feeling. Some of it is touchy feely. I mean, maybe one thing's more important to another client than the other, and you can pivot to do the plan that's designed right for them. So
Yeah.
no, I think that's perfect, Rod. Thank you.
Thank you. So in wrapping up, we'll wrap up in 5 minutes or less now. We have some great supporting material. Brad indicated that link to the Symetra Advanced Markets. We're going to make sure to get that out to you. That's beautiful stuff. We handpicked a few things here as well, which I guess I've got to go to my other screen here real quick so I can show you that. So this is a Symetra piece that we thought was really nice, creating supplemental future income with life insurance. Forgive me, Brad, but there's a couple of nice pieces from Prudential that talk about retirement planning and talk about here's that idea of that highest marginal tax rate bracket that I talked to you about. Look up here after World War II, it was over 90%. Here's where we are today. So on a historical basis, here's where our tax line is today, but look at where we've been. Okay? Taxes are going up. This is another nice piece by Prudential, Retirement by the Numbers. They're saying for 20 years, the average expense is going to be 1.7 million broken down into these various tranches. I just think this is a beautiful picture piece to be able to bring to a client and say, have you ever really thought about this? And then what would I ask them? How do you feel about this? Right? What would be important to you about this? Because that's going to set the stage. And so these are really nice pieces. We have a nice piece. It's a 3-page piece. I call it the Who Do You Know, but we call it the Identifying Insurance Opportunities. So what this is there's about 12 different types of clients that might present themselves to you. If you wanted to be intentional on this, this would be the one piece I would use. Go look through these 3 pages. Who do you know that has these certain attributes? Write down 1 or 2 names and then call George or Andrew or myself or Brad and talk about those clients and determine what kind of conversation can I have with those people and what's the best way to approach them, right? I did indicate to you that we have this World Debt Clock, and please note if you haven't, usdebtclock.org. I believe that's beautiful. And we do have a piece that is this taxable equivalent chart that effectively shows different tax-free returns and different taxable returns. And so if you reach out to me or George or Andrew, we'll make this stuff available to you. Okay, let me flop one more time. So now from here, what does that mean and where should we go? So first of all, if you have a case, please reach out to us. If we do the right kind of job, we are doing a more complete job for our clients. We're driving revenue to our practices. We're protecting our AUM, right? A person who's underinsured and their family has a catastrophe and needs dollars, there's a very good chance those dollars are coming from the assets under management. And if they're coming from the assets under management, what is that doing for you? Right? It could be eroding your income base and actually the value of your practice. We can create competitive immunity. There are some people who are insurance focused that also manage money. You're probably aware of that. They can be very good at coming in with the insurance and then saying, oh, your advisor didn't bring that to you. Would you like me to give you a second opinion on your portfolio? Right? So if we do the right thing for our client, we get the right thing for us too, and we keep competition out of our clients or out of our clients' pockets effectively. We do have a financial planning toolbox. If you haven't seen that, ask us. I don't have time to show it to you, but it's effectively has all of our best stuff in there. And it's all designed specifically about identifying someone to talk to and then positioning how to talk to them and then leading to either introducing to maybe a specialist like myself that could do joint work with you, or leading to implementation to go select a company, product, and strategy to effectively fund that, right? So with that, our next Coach's Corner, as we indicated, is the 3rd Thursday of each month. So that's going to be March 16th at 1 o'clock. So stay tuned for that. Mark your calendar now. You should be seeing something from us in the next week or two to start promoting that. And with that, I'll open up for any questions if anybody has any. While I do that, I'm going to flash on the screen Andrew's contact information, and then also George's contact information, and then mine lastly. So if anyone has any questions, you can either put something in chat or perhaps unmute yourself and come forward. If there's anybody out there, go ahead and come forward. I'll give it just a couple of seconds there. Andrew and George, I know you're out there. I don't know if you have any final last comments or if we should wrap this up as we approach 1:50. All right.
Rod, I show no questions at this time.
Okay, thank you, Tom. All right, beautiful. So with that, please join us next month. I want to thank Brad Mills. Brad, thank you again for your partnership and investing the time here with us today. And to the extent that you guys need anything, please reach out to myself or reach out to George or reach out to Andrew. So with that, make it a great day and be well, everyone. Thank you so much. Take care.